Mercia. I'll spend the next 20 minutes talking about Mercia. I'll also be joined by my colleague Martin Glanfield, Chief Financial Officer at Mercia, who will take you through some of the trading figures, which I think are important to focus on too. Mercia is a listed investment business. We're a market cap of about £100 million. We're a hybrid investment business where we take managed funds and initially support businesses through managed funds before selectively scaling those and using our balance sheet capital to scale those businesses. We're listed on AIM. Our ticker is MERC, MERC. A lot of what we do is actually within the venture capital arena, and we heard a little bit in Tech Capital about venture capital. And venture capital is a very, very challenging asset class, and I think it's worth just dwelling on a few of these numbers to bring that to light. The first thing is what we're looking at is we're looking at small, young businesses, often early stage businesses where we're looking for promise, and there's 5.6 million of these young businesses, the SMEs, small to medium sized enterprises, of which only 4% of those will ever go on to do a turnover of 1 million, which is remarkable. So they'll flatten out at 1 million. So they're not the ones we're looking for. Actually 0.4% of them, that's what we're looking for. The ones that are going to grow to 10 million or more turnover, and they're growing at a rate of over 20% per annum. Those are the businesses that venture capitalists, those are the businesses that Mercia is looking for. And we've developed a model, we think, that really works to that. That's approximately 22,000 of what they call scale-up businesses. And that sort of brings me then, forgive me for walking around, but brings me then to these sort of numbers over here, because these are just facts as well, cold hard facts, is that the median time from your first initial investment through to either a trade sale or to an IPO is 13 years for a trade sale, 10 years for an IPO. It's just fact, that's how it has been over the years. Okay, so that's worth just noting, the duration that it takes this game. The second point is, and we do about 25 to 30% of the investments we make are university spin-outs. So come out from universities, and we actually work in the Midlands, the North and Scotland, so we're a regional investor in that respect. Now our collective universities have a research income which is over and above Oxford, London and Cambridge, yet the triangle, when we talk about Manchester, we work with Manchester, but the triangle is always talked about. But actually there's a tremendous amount of activity going outside of that triangle, and that's an important phenomenon. The next thing is actually 60% of the capital that's deployed is in the capital. So 60% of venture capital put to work, just over, is in London and the Greater London region. So only 40% going elsewhere in the UK. But, back to these scale-up businesses over here, 70% of the scale-up businesses are in the regions, are outside of London. So outside of London and Greater London. So what we're seeing is a majority of the capital going into minority of the opportunities. And this really summarises how Mercia came about and what we're about in terms of playing to these numbers. But why become a shareholder? Why is it that we have, so Baillie Gifford, a local institution, why do we have Baillie Gifford, why do we have Invesco Perpetual, NFU Mutual, West Yorkshire Pension Fund, Woodford Investment Management? Why have we got these long holders on our share register? And arguably it's because of our ability, through our 19 university partnerships, we have 80 employees across 9 offices across the UK. Our access to what are potentially very disruptive tech businesses is second to none. Our access to the universities, the deep venture experience and sector experience, and I'll talk to the team in a moment, is tremendous when you have such a large team that we've built over the years. We have a track record, and I'll talk to the track record. So there's one thing having an ambition to deliver. This is a model that is already delivering, and a model that we're very proud of in terms of its early stage delivery. And you'll see on our balance sheet, so back to that model of we use funds first, and then we use our balance sheet capital, so our shareholder capital that we raised on AIM, we use to selectively scale. We have a growing portfolio of about 20 businesses at the moment, which we would argue have been de-risked through their journey initially through the funds. And there's co-investment opportunities, which was not an original driver actually. So those institutions I've talked about and other investors on our share register have said they have a desire to sit. So our balance sheet invests at what they call a sort of Series A, Series B. They have a desire to co-invest with our balance sheet, and we let them do that. You know, there is not a curse in this country of an oversupply of capital. So we welcome that opportunity onto our balance sheet for co-investment, and we see that more and more going forwards. But what is the composite? When you buy a share in Mercia, what does that bring you with? So on the one hand here, these are those, as I said, those 20 direct investments, and I'll walk through a few of those in a moment. But it's approximately 45%, so 66 million in value, is what, you know, of your share, 45% of it is related to the direct investments. Then there's our cash on hand. We've got approximately 50 million at, now these are numbers to the March 2018 year-end results, okay, so things have moved on a little bit, cash has gone down a bit, these have obviously gone up a bit. But at that period, about 50 million, so approximately 33%, 34% is cash, just hard cash. So if you add those two together, what you call a sort of hard NAV of the direct investments plus the cash, you've got a sort of NAV per share at 40, 41p. And we are 31, 32p, I think, a share prices today. We have a very profitable fund management business. We have just over 400 million pounds in funds under management as a group. And that generates cash which supports a majority of our operating costs. If you were to take that business out, that profitable business, and just compare it to listed businesses, doing it either on a turnover or on a PBIT sort of multiple, you get a 27 to 30 million sort of valuation against it, which would add another circa 90p. So whether you want to say 41 or 50p, there's a rough value of what's within, if you like, a share on a NAV per share basis. And what it is that investors were finding, and our share price has started going up, and they sort of those investors that are coming onto our share register at the moment are sort of hunting in these two groups. You know, crudely, value investor or momentum investor. You can quite easily see, just on a hard NAV and compare it to where the share price is, that there is a value opportunity there. But also momentum, our share price is starting to go up. The assets over here are developing well, and you'll hear more about how we've got returns coming through those. And so there is a general momentum within the sector, and indeed within Mercia, that investors are coming onto as well. But what I'd like to do is just two slides to show you our own momentum and our own growth. So Martin and I, we took Mercia Technologies onto AIM December 2014 with 6 other people, so there were 8 of us at the time. So if you imagine a day before we listed, we were a business turning over £700,000 approximately, with about 30 million in assets under management, one office in the Midlands in Henley and Arden, but a very bold objective, which was to become the leading investor, not just in the Midlands, in the West Midlands, but the Midlands, the north of England and Scotland. But importantly, focused on this line here, which is that there is a regional hotbed of innovation that frankly nobody else is putting capital to work or supporting those businesses. And that was our remit of really capitalising on that. And we had 9 university partners in the Midlands. And if you just fast forward now just over 3 years, so this is to March 2018, turnover of the business has grown now from 700,000 to 10.2 million. We have about £500 million of assets under management. That's gone up from 30 million, of which 400 million of us, as I just said, is in our funds under management. And within those funds, and I'll show you that model in a moment, we have about 190 tech ventures within that portfolio of future potential investments, because this is a portfolio game. If you put everything into 1 or 2 assets and they don't work, you've lost everything. So it's a portfolio game that we play. We've had 3 balance sheet cash realisations, and that's particularly pleasing, certainly for myself, in as far as when we brought this business to market in 2014, we said it would be at least 3 to 7 years before we would expect to see the balance sheet make realisations. And we've been fortunate enough to make a cash realisation, full cash realisation, each year since listing. We now have 9 offices across the Midlands, the north of England and Scotland, and we have a little over 80 employees, and we are slowing down our employment rate, but we still expect that to be around about 90 by the end of this calendar year. We now have 19 university partners, and as I said, they account for about 25 to 30% of our activity. We don't have a board built for today, we have a board built for our ambition going forwards, and a board that reflects the sectors that we play in terms of regulatory. We're in a highly regulated environment, in terms of the regulatory environment, in terms of the entrepreneurial community that we work with, and entrepreneurs are very much at the centre of everything we do. Our investment team is slightly unusual in as far as what we have is through our funds we have pure play, purebred venture capitalists who transact, unearth and do deals. But when we selectively bring businesses across to the balance sheet, we have individuals who have built their entire career in scaling businesses. That's the one piece that's the difference between the 4% and 0.4%, is how do you scale a business that's doing $1 million to a business that you want to do 30 or 40. And what I can tell you, within our portfolio, we have businesses that are doing 30, 40, 50 million. So they do go through there. Nicola's worth pointing out, is we have a university team that interacts with universities. One of our university's partners is Edinburgh. Actually, we have an office within Edinburgh. Nicola heads up our university team. Now I'm going to take 1 minute at least of your time to work through this, because this is at the heart of everything that we at Mercia do. So this sharp end is where our deal flow comes to. So we have a number of inquiries over here. In the period, these numbers are taken from our annual report, and everything is downloadable from our website. We have videos on there, we have blogs on there, we have every piece of information you can imagine about the business and its model. We've got 2,000 business plans here. So inquiries, approximately 2,000 business plans into the front end here, and then the funds invested in about 5% of what we saw. And then in this period, 3 businesses from those 190 came across as balance sheet investments, what we call emerging stars. So in other words, there's a 0.2-ish% chance of this business plan ending up on the balance sheet. Now everything looks great at this point. Anybody here who's invested in young businesses will know that it all looks good on day one. But unfortunately, within here, 50 to 70% of them fail. And so we spend our time in the funds building good, strong businesses. And then when they need that scale-up capital to grow faster, we bring them across onto the balance sheet. So within the funds, we're trying to build a position of 10 to 30%. So the funds are trying to build a position of 10 to 30%. And these funds are regional funds and EIS funds. A number of you recognise EIS and EIS investment. It's a tax wrapper that offsets the risk and the opportunity in terms of capital gains tax-free events as it goes through. Also, we have regional funds, Northern Powerhouse investment funds, and Midland Engine investment funds. So we have government-backed funds in there. And what I can tell you is our oldest government-backed fund in there has given British Business Bank some of the biggest cheques they've got back. So our funds make people money. It's not like this is here to support this. This is an altruistic setup here. If we fail to provide returns to our clients, we don't raise any more funds and the model falls over. We need both of these things working. When they selectively come across onto the balance sheet, which is anything from 6 months to 6 or 7 years, we then deploy capital initially on our own. We are trying to build a 20 to 40% equity stake here on our own before we go out and syndicate with others. So we're trying to build a meaningful stake, and you'll see in a moment how we've achieved that. And then, as I said, those 3 exits here, these are full cash exit returns back to the balance sheet as we look to recycle capital on the balance sheet. Science Warehouse, Alinea, and Absina, and I'll talk to a couple of those in a second. And this just shows the pace of growth at Mercia. So a couple of years ago, across the group, we invested £20 million across those regions. Last year it was 46, and this year we expect that to be over 60 million. So as a business, we are growing faster than ourselves as well. Just a couple of the exits I was just talking about. Alinea, University of Warwick spin-out, we sold that to Arm a couple of years ago nearly now. 21 times investment cost, original investment cost for the balance sheet was the return there, and 26 times for the funds on original investment cost. Science Warehouse, so Coventry business, Science Warehouse, Leeds business, that was sold very recently, full cash return again back to the balance sheet, regional business. And then Blue Prism, some of you may be familiar with Blue Prism. Blue Prism was in one of our oldest funds. That fund invested over a period of time, something like £900,000. You'll be familiar with Blue Prism, listed on AIM maybe 3 years ago, 48 million. Looking at it just a while ago, it's 1.8 billion market cap now. Our £900,000 investment from the fund has returned over £70 million back already, and we expect to make around about 100 times our money. We still own a chunk of Blue Prism, that fund does. So those are showing you the sort of returns over the sort of time frame, but importantly, Liverpool business, from the regions as well. We intend to be category leaders in these 4 sectors. And these 4 sectors reflect the strengths of the UK and the strengths of the university partners that we have within here. And if you look across here, these are to do with our balance sheet investments. So those investments that have come across onto the balance sheet, those 20 businesses I alluded to before are roughly spread against those 4 sectors. And I can take some questions on those 4 sectors later on, but just in the interest of time, I'll move on. The 19 university partners that we have, and we are talking to a number of others at the moment, are only in the regions. So it's getting back to our fixed focus on those regions. And you'll see a number, of course, in Scotland, and as I said, Edinburgh is an important partner of ours, and we've done a number of deals already out of Edinburgh, and we have an office within Edinburgh as well. So the next 4 slides, very quickly, are to do with those 4 sectors that I talked about. So we've taken a representative number of companies from each of those sectors. First thing to look at is the equity stakes here. So, as I said, we're trying to build 20 to 40% stakes, and you can see that's happening along here. Alistair, who heads up this sector, he's actually based in the Edinburgh office as well. tremendous experience in the software background. He's scaled a number of businesses as CEO and CTO himself, and brings a huge amount of discipline through him and his team. And so this is balance sheet scale-up opportunities. If I look at VoxPop Me, because it was one of those three that I talked about that came across from the funds onto the balance sheet just recently, this is a business that is growing on a revenue terms just over 100% per annum, growing very quickly. We are building our stake. We continue to build our stake in that one. We're the only investor in that, building our stake, and so we hold that at cost, of course. That's a video analytics business where they're actually tagging, meta-tagging the data, and they have partners such as Tesco's, etc., who use that. And again, I can talk in more detail about any one of these investments that we have here. So digital entertainment, it's the second largest sector in the UK behind fintech, behind the financial services. So digital entertainment, this is headed up by Mike Hayes. He was formerly actually the CEO at Sega. For any of you who remember Sega games, I certainly can remember playing Sega games a lot. And he was the CEO of America and Europe in that respect. So we have a number of businesses again. You can see again the equity stakes between that 20 to 40% we're trying to build. nDreams, so focused on that one. VR. So how many of you have tried a VR headset? Thank you. I said that in Boston a little while ago, then 2 people put their hand up. So if there was a room full of 20-year-olds in here, every single hand would have gone up. And that is the generation that people are going to be buying these things through. And we're always very cognizant when we're making investments to remember who the future customers are going to be of these products and these companies. Now, nDreams is probably one of, if not the leading VR software developer in Europe. It's got partners with, and these have been announced, it's got partners with Facebook, it's got partners with Microsoft, it's got partnerships with Google. It recently announced, and we did an RNS, a very large multi-million-dollar partnership, but I'm afraid we can't disclose who that was with. Electronics manufacturing, materials engineering, led by Mark Valantham in this process. So I'm not sure how many of you are lucky enough to own an Aston Martin, a DB11, DB12. Impression technologies, they do very complex shaping in terms of aluminium shaping and lightweighting, and they press out many of the complex parts in the DB11 and DB12 cars. Very, very interesting and exciting business. We hold that, I think, just marginally above cost. So again, we're on our own in that regard in terms of setting it. We expect over the sort of 3 or 4 years to start to lift these up as we syndicate, but at the moment, a lot of these are last round of investment or at cost. And lastly, in our sectors here, life sciences, headed up by Peter, again, tremendous entrepreneurial background and experience in that respect. Oxford Genetics, I'll talk about selfishly because I sit on the board of Oxford Genetics, and also I'm a type 1 diabetic. So why is that relevant? Oxford Genetics sits in an area which is operated in synthetic biology. And Martin has heard this 100 times, now 101 times, which is the world in therapeutics and medicines are split between large molecules and small molecules. You have a headache, you take an ibuprofen tablet, it's a small molecule. Large molecules, the first large molecule to come to the market in 1982 was insulin. Today, 20% of all medicaments that you are available to you are large molecules. By 2021, 2022, they estimate that to be 50%, and it could be more if they could crack the how do we make more, how do we increase the volume of production at a lower cost of goods. Synthetic biology, CRISPR technology is one of those solutions, and Oxford Genetics is one of the leading players in that market. This is a very exciting business, and that again is growing at over 100% in revenues per annum. Most of our balance sheet assets are into high revenue growth, and that's one of the defining commercial aspects when they come across to the balance sheet. The numbers.
Thanks, Mark. Hi, good evening, everyone. I'll just literally take a couple of minutes to just highlight 1 or 2 of our key numbers, and these really show the progress the business is making that Mark's described since our IPO. These are our most recent summarised results for the year to March 18. And although we're predominantly a balance sheet investor, this is what our business case is all about. It's growth in the value of our investments, drives growth in the value of our net assets, drives growth in our share price. That's why our cornerstone investors have invested in us. However, what we are also focused on is minimising the net expenses which we incur through developing our business model and employing the 40, 50 or so investment professionals that are making the dozens and dozens of investments in our funds, which then lead on to a select number of balance sheet investments. So as you can see, between 2017 and 2018, we've achieved a really decent amount of growth in our revenues. And that's being driven largely from an acquisition that we made 2 years ago, which was a business called Enterprise Ventures, a very successful established business based in Manchester. And we had a contingent deferred consideration target for them to achieve, which is they would generate 80 million of new funds under management in the 2 years after we bought them. And in fact, they achieved nearly 200 million of new funds under management in the 2 years that ended this March. So as you can see, not only are we reasonably good at developing our own portfolio of investments, so far we're not doing too bad at spotting good acquisition opportunities either. So that's been driving our revenue and helping bring our cost base, our net expenses down. As Mark said, we've sold businesses and we've realised cash gains in both of the last 2 years. And as you can also see, the value of our portfolio is growing, not just because of the cash we're investing, but because of the value of those businesses is going up as well. The deferred consideration I've referred to, and we paid that out in full happily because of the fantastic success Enterprise Ventures has had in growing its funds under management. So we are, at a bottom line, we are a growing and profitable business. And in our balance sheet, as Mark said, really there's two big numbers in our balance sheet. The value of our portfolio, which is growing all the time, and also we had, in absolute terms, we had 53 million of cash left. We expect to invest in this current year 25 to 27 million pounds into this balance sheet portfolio. So I know with a lot of AIM companies, there's always a concern about what is their cash runway, how long have they got to last, when is the next funding round coming? We expect to have circa 20 million of cash left on our balance sheet next March. So we are very well funded, we have a very long runway, and that provides us and our shareholders with a great deal of security. So our net assets are growing, and if we just flick on to the next slide, I'll talk a little bit about the portfolio and the makeup. So Mark's talked about the main 20 investments that make up 99% of our portfolio. You can see the names there. You can see the profile, really, of how we go about building our business. So we started the year, say, with sort of 17 companies. We've added 3 during the year. You can see how we've invested in almost each of them during the year. You can see where we sold Science Warehouse during the year, so that comes out of the portfolio. So we invested 21 million, but 10 came back at value, and then we actually made another cash profit on top of that, taking it over the 10 million. And then we have a series we value each of our companies quite prudently. So we don't extend and pretend. If something's not going quite right and is not on plan and is significantly behind plan, then we will adjust our valuations. And you can see there are several cases there in the year where we reduced the holding value of our companies. None of our companies are valued on a discounted cash flow basis. These are young companies that we value prudently, either at cost or if there's been a funding round with a syndicate partner, then we'll value the investment at the price of that last funding round where there's third-party evidence. And as you can see, as I said, at the end of March, we'd got to 66 million, and we've continued in this current year. Thank you. I'll stay here for any questions.
So, I mean, this is the closing slide in summary. You know, Martin and I, the team, we're focused on NAV growth. How do we drive value in those direct investments after we've built big stakes in those businesses? Minimising cash erosion. What we want to do is make sure our balance sheet capital is put to investment purposes. If we're going to try and make 21 to 100 times our money, every time we burn a pound, we're giving up that chance of doing that with that pound. So minimising cash erosion, which sometimes I think people within this sector lose sight of, is absolutely critical. When you've got over 80 employees, when you have 9 offices, 19 university partnerships, we see everything. So we see everything, and leveraging that power to seeing everything and deciding what to support as projects, young projects, before they get into the funds, and then through the funds, is a critical element. So leveraging that to the benefit of our investment model is absolutely important. But fundamentally, we're all judged, all of us are judged on track record, our ability to deliver. And it's really pleasing in what is really just sort of 3 years on AIM, is we've shown that we can deliver from the funds and importantly also from the balance sheet. And we're starting to see some very interesting and early stage metrics coming from the rest of the portfolio. Thank you ever so much for your time.
Thank you very much. Thank you.
Okay. Very good. Do we have any questions? Gentleman at the front, please. Peter.
Good evening. To what extent does your G&A get covered by income from your investments rather than capitalisation? And if it's not covered at the moment, how long do you think it will be before it would be covered?
Okay, so approximately 70% of that sort of 10 million of revenue is revenue that we generate from managing the funds under management. Another 1 million of that is generated from the fees that we charge when we make investments into our balance sheet, and the balance of that 10 million is the fees that we charge for providing the expertise of our investment team to those portfolio companies. So in addition to that, where we have realised gains, where we've sold something, we've obviously made a cash return as well. So our objective in the medium term is to ensure that every year the net expenses is more than covered by the disposal proceeds and the realised gains from companies that we will have sold from the portfolio.
Still need to sell to cover your expenses.
We will do, yes, absolutely. We intend to evergreen this model, essentially, in the medium term. And that would be something, when we get there, that, dare one say, not too many of our comparators who have been on the market for 10, 15 years have yet been able to achieve.
Would you, if fund management companies are trading very high multiples, spin out the kind of fund management? I've been asked this before. As a separate entity, would there be a case for that?
So Martin always says never say never. So I shan't say never.
No,
but the fund management business is a fundamental part
Absolutely.
of the investment model.
Yeah.
So we can, I was saying this earlier, we can take this opinion where we can say, you know what, we're going to take a 7 to 15 year opinion on this early stage investment as to whether it's going to work or not. Because we know 7 years maybe of that journey is in the funds and therefore not in the city's eyes. Yeah. What the city gets to see is what comes selectively across onto the balance sheet. Now if we took that away, are we really going to start using our balance sheet capital to go early? I suspect not, because that's at the heart of the model. And then the balance sheet part of it is like a cheap... So for the shareholders in the fund, it's a cheap fund. You know, you have this 2 and 20 mentality. It's 2% annual management fee, there's a 20% carried interest part in it. That's a very common venture capital sort of analogy. With our balance sheet, based on last year's trading figures, it's about a 0.4% in terms of the management fee, because that's the cost across the group, and we have a 10% carried interest position in it. So actually, it's a cheap fund to get into, and the cost of that, and the reason why it's 0.4 and not 2 or more, is the fund management business is generating cash.
And there's a couple other really important reasons, which is that we have transferable preemption rights in our fund management business.
That's true.
So what that means is, when it's time for those businesses which have emerged to scale up, we have an automatic right on the balance sheet to invest at least at the same percentage that the funds have built up. Obviously, if we sold our fund management business, which, by the way, has got approximately 200 companies in that already. So there's our pipeline, there's our deal flow, and it's a profitable business within Mercia. No, we
Are you going to say never?
almost never. Almost never.
Another question here, please.
What would make you realise a loss and bail out of a company? Do you set sort of your exit price from day one or very early on? Because the two examples, because there's two listed companies on there you quoted. I think Blue Prism is on I'm pretty sure it's on a silly PE of about 200 or something. I'm not in Blue Prism, unfortunately. And unfortunately, I am in Concepta, which has been an absolute disaster. So,
But which has just successfully raised a new funding round.
at discount to market price.
Yes, absolutely. Yeah.
Heavy discount.
So the truism is that not everything works straight away. Okay, so what we're not saying here is these businesses are going to be worth a fortune next Wednesday. What we are saying is there's a very good probability that the majority of our businesses on our balance sheet will have a significant value in the medium to long term. So Concepta has all there are traits about Concepta over the medium to long term that we still believe in. We took part in that investment round. So Blue Prism was a business where it was 2 or 3 people when we initially supported it, with a very ambitious program that they were trying to deliver. And when we took it to AIM, it was turning over virtually nothing. It's got a turnover of 30, 40 million now, 3 years later. It's growing fast. So it's not based on what its current trading is today. Its value is based on what they believe, the market believes its trading will be. And it is truly a global business that we should all be proud of. This is still a business based in the north of England. So we should be proud of that business. We, in terms of selling, we're making 80 times our money. There comes a point where, when we've been in it for 15 years, there comes a point where it's the right time to sell. That doesn't mean we don't believe in the business going forwards, but we have an obligation to return capital back to clients in the funds or to evergreen the balance sheet. We do get failures. We have had failures on the balance sheet.
We have, yeah.
And we're very open and honest about that. And we will, if we take provisions, if a business is going not against plan, and we've provided when a business has performed poorly against a business plan, we do provide that publicly. So we're very pragmatic on our, we will stand behind those valuations, that's for sure.
So I'm trying to ask a question you can answer, but if I can use Concepta as an example, have you invested in the product or the management with Concepta? Because I think they've got a very good product, but the management just have not performed. I mean, they couldn't even get the packaging right, could they?
So we've invested in the market opportunity. No, seriously. I think that's... So yes, there's intellectual property there, which we've invested in as well, but what we believe is that market opportunity is worth pursuing.
I mean, what we can't do, it's a shame because I'd love to flip back to the slide of the 20. You'll see where Concepta features on the balance sheet, and it's quite low down. So I appreciate you're a shareholder in it, as we are.
Graham will put the slide back up for you.
So there's Concepta. Okay, so in terms of driving value within Mercia, we absolutely believe it will do in the long term, but it will not materially change the world for us.
No. But it's not a business that we're yet ready to give up on. Whereas we have let 2 or 3 other businesses go, even though they made it to the balance sheet, because either market conditions have changed or they've not actually ultimately been able to get the market traction, which we'd all hoped that they would.
Can you tell me when you are going to give up?
I think. So we are out of time, but there's a chance to ask a question. So if you'd like to.
Are you taking your university innovators and students with you in this journey?
Oh, wonderful question. So we run, every year we do a gala event, a gala dinner. What we try and do is bring all our stakeholders together. So our institutional investors, our private investors, our fund investors, our portfolio in the funds, our portfolio on the balance sheet. And last year we had a guy called David Lacumba give a presentation. And David used to run Alinea before it was bought by Arm. And David was the postdoc in Michael Rudyard's group. So he was the postdoctoral student who came in, who grew within the business to become the chief executive of that business, and he did an excellent job. So where possible, we're always looking for that postdoc, actually. Where possible, we want to bring people who understand and live and breathe that technology, because very often, certainly in the early days, they are the technical sale asset. They are the one that's going to sell that first few products. And so you want somebody who's lives and breathes. So we spend a lot of time trying to help people understand how they can add value to their companies.
Okay. There's a lady here.
Hi. Can I ask a question? What does 19 UK university partners actually mean?
To them or to us?
Well, that could mean a partnership agreement. It could mean a percentage of a joint spin out from the university. It could mean a joint venture with the university. It could mean basically a vehicle with the actual university itself, where they retain a share. There are lots of different options on that.
No, absolutely, I appreciate it. So Martin and I never got a chance to talk about our own backgrounds because of the time limitations. My own background is I was an academic at Oxford, actually, and came through the tech transfer at Oxford and got to experience the advantages and disadvantages of an exclusivity. And that really shaped our own thinking. So all of our university partnerships are non-exclusive. And that's because we need to be able to say no, and they need to be able to take things that we have not back to others who aren't thinking, well, you've got an exclusive agreement with Mercia, why didn't they like it? So that ability for us to say no is as important to the university as it is to us. Now, what was quite interesting, when Martin and I, when we floated Mercia back in 2014, a number of our university partners became shareholders. They put money into the shareholding. So we don't put money into the universities, so we don't give them a fund for them to do, but we work in partnership. So we work with their tech transfer team, we do coffee mornings. So at Edinburgh we do a coffee morning and a drop-in morning, so academics can come along and just say, thinking about this, how do I progress that, what do I do? So we do that softer side of things. And I would say that a number of our universities, Birmingham, Warwick, Edinburgh, to say just 3, are very, very proactive in that sort of education element, which is what it is trying to bring academics through to understand what is a spin-out and what isn't a spin-out, and why or not those are the cases. So I hope that explains the sort of partnership question.